markets. Let's connect then with Aman Chowhan, who's joining in to discuss the road ahead and what we can expect by way of triggers. Thanks much for taking time out. Just wanted to get in your thoughts first up, Aman, as to what do you believe is going to be the next big trigger that the markets are going to watch out for, given the fact that now earnings seem to be behind us?
Frankly, there are no immediate local triggers. I think market is going to take clues from the global markets. It's been a global rally since the last 4 months, and India has also participated in that. And I feel that is what is going to be the theme of the next few months also. So post the earnings season, immediately there is no trigger. The only trigger now is, I think, November, December, the state elections, and that's still some time away.
Immediate domestic triggers as such, but talking about earnings itself, the earnings season has been all right for the entire financial space. We have seen either inline set of numbers or a beat coming in versus expectation. Are you looking at broadening your horizon when it comes to financials? A lot more PSU names, a lot more smaller micro lenders, etc.?
Yeah, the financial space looks good, and within financials also we are pretty positive on the microfinance. We are pretty positive on the housing loan segment, NBFCs, which are leaders in their respective space. And I expect this rally to spread. More and more mid-sized private banks can also be looked at, and that is also trading at decent valuations, and that is something where I think the investor interest will soon come in.
How you been?
Hi.
Yeah, I was hoping you hear my voice and there would be a lot of excitement in terms of saying a hi. Delay sound kar rahe ho?
Yeah. I'm pretty fine. How are you doing, Nikhil?
With railway stocks, with NBFC stocks, with manufacturing stocks going higher, I was hoping that there would be a lot of garmahat in your voice. But we'll keep that aside for a cup of coffee. Let's understand what is in store for investors now. For those who are looking at, let's say, investing fresh money or fresh capital, should they expect a meaningful upside in next 1 year, or market returns will not be exactly like what we saw in last couple of months?
Last couple of months has been a one-way rally, right? So one cannot expect the same kind of return in the next 6 months. If it happens, it's an additional bonus, but that should not be the expectation while coming in. You should expect a high single digit or say mid-teen kind of returns. If you get returns anything excess of that, that's an additional bonus. But that should not be the criteria for one to look at equity markets right now, because last 4 months, as you know, it's been a tear, right? So it's been just a one-way market, and that should not be the base case.
You bought a lot into railway stocks, and I want to bring that theme out because that theme has done exceedingly well in the last couple of months. At this current juncture, when railway stocks have started commanding P multiples of almost like capital goods stocks, is it time to get out of railways, defense, construction?
Yeah, so we are positive both on cap goods as well on the railways teams, but within that one needs to be careful, right? So if stocks start trading at 30 times FY26 multiples, that's not a level where one should be looking to invest into these names. There is a good runway. There is a good runway for the next 2 to 3 years at least, because most of the railway stocks are seeing good order inflows. The companies that we have invested, their capacities are booked for the next 3 years. But beyond that, for growth as well as for the existing demand to sustain, continuous flow of railway orders should come in. So while the next 2 years is set, one needs to see as to how the railway ordering pans out. So markets seem to be already discounting FY26 numbers also, and that's what the peak turnover could be. So one needs to be careful. I would not get into railway stocks or cap goods stocks in north of 30p. If something is there around 15-20p, then it should be considered, because the traction is there. The kind of ordering activity we have seen and the kind of modernization that's going to happen in the railways, this is definitely a good interesting space to look at.
Exactly a year ago, we had a conversation on mid-tier banks. I said no, you said yes. And the conversation was that mid-cap banks will struggle in a credit cycle. because large banks were gaining market share. We are in a setup where both are gaining market share now. How do you see the situation moving for mid-cap versus small-cap banking? Because the deep discount which was there a year ago, I think that's missing now. Is it time for me to say yes and time for you to say no? Could it reverse?
Difficult to say. So what we are seeing right now, that there is a sectoral tailwind. So all the financial institutions are benefiting, and we are at the, you can say, if not immediately, but in the next 6-9 months, we can see a rate cut happening, and that can be a very big trigger for all the financial stocks to go up, both large cap banks as well as the mid cap banks. So within that, I think now from here on, banks that can gain market share and that can improve on the NIMs is what is going to do well. We have seen HDFC Bank as a stock, it has not done well versus say what an ICICI or an Axis or you say even an IndusInd Bank has done. Similarly, in mid-cap banks, City Union Bank has not done that well, or there are other banks that are not done well versus say what another performing mid-cap bank or say microfinance stocks have done well. So from here on, whoever can handle the NIMs well would be a clear performer. I don't think there is going to be a large cap versus mid cap differentiation now. It's going to be very stock specific, both in the large as well as in the mid caps.
So financial seems to be the consensus trade that you're talking about, but which is the most underrated sector you would say, Aman? Is that technology?
Technology, yes, but at the same time, stocks have not corrected the way the results have been, the way the Infosys revises guidance. There's not been a much impact on the stock price. So I think there's another 1 or 2 quarters before which people start looking at technology. Chemicals is one space which is underrated right now because clearly we are seeing earnings headwinds. We are seeing margin pressures because China's supply has opened up. So that is also something for the next 3 to 6 months. One should be very watchful. Don't jump in right away, but there will be an appropriate time to look at the chemical sector also. So both these sectors right now are being you can say not ignored, but not the market favorites, but in the next 2 to 3 quarters, they can get interesting.
Okay. So let me divide my next question in perhaps 3 parts. First, for next 3 to 5 years, what to your mind is the big trend? For example, buying into railways and defense was a big trend. That's part 1 of my question. Part 2 of my question, what to your mind could be a tactical trade right now? For example, it could be metals, it could be autos, it could be chemicals. And third part of my question is that where do you see market right now just not just over believing in that trend, manufacturing or whatever you think? So 3 parts to my question.
First, the mega trend could be one where we see a shift from unorganized to organized. So whichever sectors, whichever companies are facing unorganized competition, I expect a clear market share shift happening from unorganized to organized. It could be because of GST, it could be because of new policies by the government. So this can be a good mega trend where the organized sector will gain market share. Second, sorry, I missed just second question.
Tactical trade, tactical trade just for the benefit of our viewers, where you think that next 3 to 6 months, a 15-20% upside could be there on the table.
We are positive on metals from here on, and that can be a tactical trade for the next few months. Expect dollar to softening, and that can help commodity prices, which in turn will get reflected in the stock moves also. And the third one, we are clearly avoiding chemicals right now. So we have pared down our exposure to chemicals also, because in the near term, there is a significant headwind both on the volume front as well as on the margins. So very few companies within the sector are benefiting from lower raw materials, but a longer list of companies are facing headwinds because of lower chemical prices. So that is something that we are clearly avoiding, and these companies still trade at north of 30 multiples, right? So not something which is a very exciting valuation either to look at. So if there is no earnings growth, I don't see any reason why this 30-35 multiples should sustain.
Aman, what's your view on autos? Do you think that big upside is already made and now there'll be just a bit of sideways move on the auto, or more legs to the rally?
We have not been a very big bull on the auto sector. We have some auto ancillary stocks in the portfolio, but nothing on autos directly, because we feel not Indian companies are not well prepared for the EV, and EV is still a very small component of some of the companies like say Mahindra or Telco. That's the reason we don't have a big auto exposure, and I think we'll maintain that stance. I don't see myself getting into auto stocks anytime soon.
Final question, in terms of the valuation setup and in terms of the global macros, do you see a risk to the market, or do you think that we may not rise higher from here, but a reversal and a sharpish volatility is unlikely to come in?
So markets have done pretty well. There can be a round of profit booking. I don't see a sharp correction, but as after, see, mid caps have gone up anywhere from 50 to 100% in the last 4 months. So a 5, 10, 15% correction or a profit booking can easily happen. But I don't see markets just dropping off the cliff. It's not that the bull market is over and we should be fearful about something, because there is no reason to suggest that. The whole rally setup which has happened in the last 4 months is also because of the fact that people are pretty excited the way CSFB and the regional banking crisis in the US were resolved by the central bank. So now everybody is of this view that anything goes wrong, the central bank will step in, and in a week, 10 days time, they will address the issue, and there won't be a contagion kind of an impact. And that's what is fueling the bulls. And I don't see any reason why this view can change. And on top of that, we are sitting on the macro setup where interest rates are bound to come off. Inflation is coming off, both because of slower demand and the base effect. And if that sustains, which is very likely, then we are heading for the rate cut cycle, which is also a fodder for the bulls. So keeping these two things in mind, I don't see any reason why the market can see a sharp fall. But having said that, it has risen quite sharply in the last 4 months, and a small time correction or say profit booking can definitely come in.
Okay, Aman, on that note, we'll let you go. Thank you so much for joining us. Before